Hey, thanks for tuning in. Today I'm going to discuss how to catch a falling knife, or in other words, how do you know when the market is done falling? In this example, we're going to take a look at the ARK K Innovation Fund. Um, this is the daily chart. How you label this correction is not nearly as important as the concept of letting the market put in a reversal sign while you are not in the trade. It's very important to be objective, right? So let's take a look at this here and walk through it. So from the top, she topped back in February. She started to give up the EMA 5, SMA 10. That's the first clue, and then really the nail in the coffin is closing below the 20. So as soon as you close below the 20, it's pretty obvious that the correction has started. You also did put in a reversal candle here on lots of volume on the 23rd. At this point, we're not interested in anything, right? We just got stopped out of the trade. If you were long, you had a bearish divergence. You should have been selling into strength. 3 new highs, 3 lower lows, or 2 lower lows after the first high in momentum. This is what you see at major tops and major bottoms. Although price made a higher high, momentum did not. As price fell below the moving averages, that's confirmation that the correction has started. You don't know how deep this is going to go, so this is your first reversal candle on volume. You notice they retraced 100% of it, broke below, but closed back inside that range. She then launched all the way back up to test the 5 again, closed above the 5. That's a bull trap because she gave it up the very next day. So at that point, you had already seen that SMA 10 is sloping down. It crossed below the 20. 5 is sloping down, crossed below the 40. At this point, you should be all out of this trade. Should have been out right here. If you didn't leave there, you should have been out here. Let it fall. Do not participate in any of this unless you're participating to the short side. When it gets down here, you've got this large wick on massive volume. You could then on day 2 took this trade, because now at this point you had declined about 25% in about 14 sessions. The market did put in a reversal candle on volume, and the next day they did retrace most of that and held the low, which is the most important part. And then on day 3, they confirmed the reversal by closing above the high of day 2 and day 1. At that point, it sets up about anywhere between 3 and 9 session trade, starting from the reversal. So 1, 2, 3, 4, 5, 6, 7, 8. In this particular instance, this is an outside reversal candle on March 16th. This is where you should have been all out of the trade, looking for, at best case scenario, a 1-2 and then a new impulse higher. Worst case scenario, a triangle, which is what you got here. ABC up, ABC down, up, down, up. So A, B, C, D, E, and then the new impulse lower equal to wave A. In this particular instance, it's the 618 extension of the wave AB. At this point, you should have been out. You could have exited because you closed below the 5. You could have exited because of the time component. You could have been scaling out of strength, leaving 50% hide behind. Trader's choice, doesn't really matter. But at any point, given the slope of the 20 and this rollover look that had happened here, you had to be very defensive. And when you got back below the 5 on this day at 122, by 3 o'clock at close, you should have closed that position. Boom, we come all the way back down to the low. They hold, come back up, set a lower high. At that point, you could have partaken in that trade. I I probably would have using this doji candle, if not the doji, the outside reversal candle here. And then bought day 2 after no retrace, right? That might have been enough for me to not partake on that day. It really would have depended on whether or not I got in on the doji, like I said at first. So that would have been my first sign of reversal outside doji. But regardless, after you got to the E, you had another impulse lower. And in this particular case, all out, all the moving averages rolling over, back to the 200. No reason to partake, right? Oh, you could buy at the 200. Why? The market is red. They sold all day. They closed below it the next day. There was no sign to buy. You could argue they held the higher low, and they did, but then the very next day they broke it. And like with all triangles, there's the breakout initially and then the back test, and that's what happened on May 7th. That was your final chance to exit if you had bought here, because at this point, everyone who had bought going back to February 16th was now red. And that's how you get people to capitulate. So they pushed her lower. Notice the slope of the 5, the 10, the 20, the 40, the 100, the 200, right? The slower moving average ones are all rolling over, sloping down. The 100, 200 are going sideways, letting you know that there still is a dominant uptrend on the longer term charts, like the weekly, the monthly. So you come down here in this most recent correction and you put in a reversal candle on May 11th on volume. So that would have been day 1. You don't buy there. Day 2, she retraced 38% of this move. And really, it was up to the trader how close to the break of candle low you wanted to get in here, or this bullish engulfing candle low. I think the low was like $99, so anything down to 99 would have been. I bought on this day right here at 101.50, 102. I don't remember the exact price. Next day, I had the opportunity to add. I did not take it. The stop here in this particular instance was the reversal candle, the low. You notice they broke it but closed inside. That's a very bullish look. And the very next day, they capture EMA 5. So in this particular instance, I did buy here. We are now above where I bought, but we haven't really confirmed that the reversal has taken place. We do have the first step, which is capturing EMA 5. Now EMA 5 is sloping sideways, which is what you want to see. You do have the volume. You do have the symmetry of the pattern. You do have the market proving it to you before buying. You're very close to risk, 2% at most. So this is a very, very interesting setup. You have the bullish divergence, just like you had the bearish divergence at the top. You got the bullish divergence here with a lower low in price, a higher low in momentum. The blue line is now curling sideways. If they can get above SMA 10, come back up here, test this 200 again, and that's the first sell this week. And if they could get above that, it certainly brings in the POC, which is back up here at 124. But the reality is, if they can't get above this low here at 106.25, then this trade is pretty much done, and the supply-demand imbalance to the downside continues, and we go to the next extension. So if ultimately this week this low is lost, this trade's aborted. There's no reason to be in it anymore. You then get out, go back to the process of waiting and letting the market prove that there's a bottom. It's much easier to do when you're not emotionally involved in the trade and you're watching from the sidelines. That pretty much concludes the video. If you like the content, like, comment, or subscribe to the channel. Come check us out on Twitter, and we'll see you in the next video.